Are growing global concerns over the banking industry. In Europe, shares of the Swiss bank Credit Suisse dropped significantly. In the U.S., bank stocks also fell following the collapse of Silicon Valley Bank and Signature Bank. Joining us now is Sheila Bair. She's the former chair of the FDIC. She also authored the children's book series Money Tales, which teaches kids financial literacy. And maybe we need some adults who should read it. Sheila, you wrote in the Financial Times you thought the banks were sound, but that the main thing we have to fear, and I'm quoting you now, is fear itself cascading into bank runs that will force otherwise healthy banks to collapse. What's your opinion of that right now? Fear versus the functional stability of the banks?
So I still feel that's the case. I think you can always have more capital, more liquidity in a banking system, but the reforms that we instituted after the great financial crisis have made our system much safer. And I do think it's basically sound at this point. We've had a few banks that have been very mismanaged, and shame on them and examiners who should have caught the problems earlier. But I don't think we should extrapolate that into some broader problems with the banking system. I just don't see that at this point.
If there are no structural problems in the banking system, what's your assessment of the fact that everybody is online all the time right now, and there is a fevered kind of public square in which conversations about bank stability exist? How much more difficult is that than it was in 2008? And how worried are you about that in terms of this other thing you pointed out, which is confidence?
Right. Well, in 2008, the focus was on the very largest, the multi-trillion-dollar institutions, which really had been more culprits than the securities firms that had more been culprits about securitizing these very poor quality mortgages that were causing a lot of losses in the economy, but also the losses on these derivatives contracts that large banks have written that magnified those losses. So this isn't really so much about the big banks now. I think it's really more about confidence. We had a couple of mid-tier banks that were not managed well. With regard to Silicon Valley, they just didn't do any interest rate risk management. They had a portfolio of securities that had lost market value because interest rates were going up. That's kind of banking 101. You need to hedge against that risk. They didn't do it. So I think there were some just extraordinary missteps by this bank that I don't think are symptomatic of broader problems in the banking system. And so, I think people should still keep their heads. I got to tell you, if you're below the insured deposit limits, the FDIC insured deposit limits, you don't need to worry about this at all. The FDIC has a perfect record of protecting insured deposits. It's been around for almost 90 years. It's never lost a penny of insured deposits yet. And for the larger depositors who are more sophisticated, there's plenty of financial information out there to look at to make sure your bank has got a good balance sheet and stable deposits. But those are the kinds of things people should be thinking about, not just withdrawing your deposits.
And that limit's $250,000.
$250,000, okay. That's right.
Let me ask you this. You suggested that the failures of SVB and Signature weren't widespread enough to merit the government rescue. Is the volatility we've seen since then proof that the Biden administration made the right call on insuring deposits, or is this volatility something that they contributed to?
Well, my fear is that they contributed to it. I think they made a really big deal out of it because a systemic risk determination is an extraordinary thing done only in extraordinary circumstances. It requires a supermajority of the FDIC board, of the Federal Reserve Board. It requires the president, the secretary of the Treasury. Everybody has to sign off. This was a $200 billion institution, Silicon Valley, a $100 billion institution, Signature, $300 billion total out of a $23 trillion banking industry. The only thing that people were worried about were the uninsured deposits, which probably would have only taken a 10 or 15% haircut on their insured deposits because these banks basically had good assets that the FDIC can sell and make recoveries to pay off the uninsured depositors. That's just the way the system works. And on Friday, the FDIC had promised to follow that process. They were going to pay a dividend to the uninsured depositors this week to give them some cash if they needed, cash flow for a payroll or whatever. That's the usual process. So I think it really ballooned this thing out of proportion by saying these small banks relatively small banks were systemic.
Sheila, do you think of the fact that you had a lot of public, high-profile people with big deposits in the bank, bigger than the FDIC limit, who were saying, we need help, essentially strong-armed federal regulators into this bailout?
Well,
that's the laugh of recognition.
Yeah, well, it's chutzpah. I got to tell you. So these deep-pocketed Silicon Valley venture capitalists and they're mostly very large tech companies ran from the bank. They withdrew their deposits. They forced the failure, and then they come back into the government and say, "Now you got to bail us out." So yeah, I think that's pretty nervy. And the thing is that people should understand that any costs associated with covering these uninsured deposits for these very deep-pocketed depositors, that's going to be paid for not by taxpayers, but it is going to be paid for by an assessment on all banks. That includes several thousand community banks that are going to be paying into this fund to cover the cost of this bailout. And so I am troubled by it.
Very, very quickly, Sheila, do you think the Fed should change its behavior based on what's happened in the banking industry relative to the expectation that the Fed was going to raise rates again?
I do. I wrote last December in an op-ed that I think they should hit pause. I'm concerned about the real economy, too, the labor market. I'm a hawk on inflation. Since 2010, I've been saying normalize rates, but we had 14 years of easy money. They're trying to, undo all that damage too quickly. They need to hit pause, assess what the impact is going to be on the economy and the banking system before going further.
Sheila Bair, thank you so much for being with us.
Thanks for having me. Great.